Alright, good afternoon everyone. Thank you for dialing in our Phillip Roundtable session. Today we are honored to have three speakers from various financial institutions to join us and have a discussion on global topics, specifically on fixed income as well as equity space. Our first speaker for today is Mr. Lim Chia Wei. He's a senior portfolio manager in AHAM Asset Management, managing Asia ex-Japan equity funds. His stock and macro research coverage include Korea and US. Prior to joining AHAM Asset Management in June 2015, he was an assistant manager in Public Mutual Berhad, where he covered China stocks and Asia telecom stocks. Chia Wei graduated with a bachelor's degree in computing, majoring in software engineering from Staffordshire University, UK. He's a chartered financial analyst, CFA chartered holder. Our second speaker for today is Mr. Shawn Singh. Mr. Shawn Singh, part of Phillip's Singapore research team, is responsible for the bond analysis and research coverage on fixed income. With passion in the finance industry, his insights and perspectives are constantly showcased, featured on Poyam's website, and generating market views for Phillip Bond Desk. He also conducts seminars and webinars on a regular basis to evaluate investment opportunities with particular emphasis on fixed income. He graduated with a Bachelor of Science in Banking and Finance from the University of London and holds the Credit Analyst designation. Our third speaker for today is Puan Hazlin Omar. She joined Phillip Capital Management Sdn Bhd as a fixed income portfolio manager in November 2020. She has more than 20 years of experience in both treasury and investment divisions of various financial institutions. Her main responsibilities are to assist in managing fixed income and money market portfolio for the clients. She is also responsible to carry out research activities and produce research reports on various companies, financial instruments, business sectors, and general economies for investment decision-making and reporting purposes. She holds a Capital Market Services Representative license. She is graduated with a Bachelor of Science in Business and Administration Finance from Oklahoma State University, the United States of America. Right. 2020 is a unique year where both equities and bonds suffered huge losses. In 2023, we see global equities are making considerably good gains while fixed income prices have stabilized. Several economies are now shifting their perspective from predicting a recession this year to forecasting no recession. What will be the outlook for Malaysia fixed income as well as global fixed income and equities for remaining of 2023? Because this is a very broad question, perhaps we can start with Hazlin to share her perspective on the Malaysia fixed income. Over to you, Hazlin.
Okay, thank you, Kim. Good afternoon, everyone. Thank you for listening to our Phillip Roundtable today. Okay, maybe I can start with some update from on the second quarter GDP, which was announced last week. Our second quarter GDP was increased it's a small increase actually by 2.9% year on year compared to the market consensus of 3.3%, and which is lower than the first quarter of 5.6%. I think going forward, we expect the pace of economic expansion in Malaysia will likely to stay moderate due to the slowdown in global economic growth and the concern of weaker than expected export growth. Most of our local economies lower their full year GDP to around 3.4 to 4% from the previous high of 4.5%. From the Bank Negara perspective, Bank Negara recently saying that the record of slow growth going forward due to the lower end of their forecast of 4% to 5%, their forecast range for this year. So they are expecting around 4% for the full year GDP. Bank Negara also mentioned that the growth will be supported by continued improvement in the labour market, implementation of new and existing investment projects, increase in tourism activities, and from the mining sector. On the downside risks, remain from the weaker than expected global growth and prolonged technology down cycle. On the upside, tourism may pick up further, and investment project may progress faster than expected. We expect the economic growth and inflation to be moderate for the rest of the year, and we believe that Bank Negara will maintain the OPR unchanged at 3% until the end of the 2023. On the local bond market supply side, we expect 50 to 60 billion new issuance from corporates, and another 84 billion from the MGS DRI in the second half of the 2023. So we believe that the bond market will be well supported as our market is flush with liquidity. We believe that local bonds will stay steady despite of weaker ringgit, and but however we expect the MGS 10 years to be traded slightly higher than current level of 3.85, even though the US Treasury already increased by 40 basis points, but the MGS still steady despite the increase in US Treasuries. It shows that the ringgit, the local bond market remains supported. Okay.
All right. Thank you so much, Hazlin, for your sharing on Malaysia's fixed income space. Shawn, would you like to share more on global income perspective, fixed income perspective?
Yeah, sure. So as rates are expected to reach its peak alongside the dovish sensing from the FOMC members, indicating that their policy has somewhat gotten to where they wanted it to be. So I mean, this definitely instills more certainty that the rates would not be as volatile as what they have experienced in the previous years, where it seems like there's no ending to the climbing of the rates. So I mean, with rates starting to stabilize in the later half of this year, we would be hoping to expect much more volumes of newer bond issuance to arise in the later half of this year, perhaps in Singapore in the space. So for our clients, our view for the second half of the year is to accumulate new issuance, preferably issuances with investment grades and with sound financial and capital management. So this will enable investors to capture the potential capital appreciation and lock in the decent rates for the following years to come when rate starts to taper in the later half of the following year subsequent. Yeah.
So we have covered global fixed income. What about equities? Over to you, Chia.
Yeah, thanks, Kim. To talk about global equity, we will separate it into, let's say, the developed market, the US, Europe. Then we'll touch on the Asian equity market. In the case of the US and European stock market, the two key things that are in everybody's mind is one is really the risk of recession, and two is inflation, and related to the second one, inflation, is really the bond yield, what bond yield is doing. Recession, to start off with recession, I must admit first that I got it wrong. I thought US recession would play out sometime in property issue. It is having a very big impact to China's overall economic activity. So that's the first point. What happened next going forward? The government has somewhat recognized the issue and is starting to introduce certain policy measures to support home purchase activity. They have also lowered mortgage rate in certain cities, and they also loosened some home purchase restrictions. Our assessment is that so far what they have introduced, the new measures that they have introduced, it's good, it's better than nothing, but it's still not enough. Our view is that it won't be enough to change the home buyers' confidence. Now, the problem with the property market now is home buyers, people who used to buy property and people who are likely to buy property in China, they have very, very little confidence. And the current measures introduced is not enough to turn that around. So I'm afraid the weakness in the property market could be there for a while more. unless until the overall China GDP starts to slow down materially. For example, they are targeting a growth target of 5% real GDP growth this year. If in the next 2 quarters, GDP growth comes in significantly below 5, maybe below 4, or even below, especially if it's below 4%, then I think the government may step up some of the supportive measures. But we really have to summarize, we may need to see more weakness in the property market and the overall economy before we could see the government take a bigger step to try to support or stimulate the property market in China.
Yep. Thanks, Chia Wei, for that. A follow-up question on that, Chia Wei. Recent data indicates that the US economy has displayed considerable resilience, whereas China's recovery appears to be facing certain challenges. Given this scenario, is there potential for both of these major economies to continue to experience a recovery? And from an investment standpoint, how should we strategically position ourselves, Chia Wei?
The way I would look at US economy is that the resilience and the strength of the economy, most of the things are okay. They should be able to continue to grow quite well. But the only thing that is the key risk that is really pressuring the US economy and could gather pace, that means the pressure could increase over time, is really the high interest rate and high bond yield. When you have high interest rate and high bond yield, it means if you're a consumer and you want to buy a property, a home, or you want to buy a new car, you will realize that the interest rate is now much higher compared to a year ago. So naturally, that will discourage a lot of people. They may say, hey, okay, I will wait a while more. I will delay my property purchase for a year. Let's see how after that. Or people who wants to buy a new car, they may say, I will delay. Let's see how. Hopefully the interest rate will come lower before I decide to buy. So that is a strong element that that puts a pressure on US economic growth. And it's not just on the consumers. Even if you look at the businesses, they do borrow money. Usually when they borrow money, they lock up their interest rate for about 3 years, 5 years, or some even up to 7 or 10 years. But not all of them, their interest rate is locked up 5 years down the road or 7 years down the road. Some of them may have borrowed money a few years ago, and in this year or next year, their loan will mature. And once it matures, they have to refinance it. And any company that has to refinance their bank loan today, they will find that they have to pay an interest rate that is much higher than, say, a rate that they paid 1 year ago or 2 years ago. So businesses may gradually see that even their interest expense is rising. And over time, as more business loans mature, more businesses are forced to refinance at higher interest rate. You will generally see more businesses struggle with higher interest expense. And when businesses struggle with higher interest expense, they will start thinking about cost cutting to make up for the higher interest payment. And one of the key things in US for cost cutting is really employment costs. So they may decide to let go of some people. Then that may lead to weaker consumption when people lose their jobs, and that could be the beginning of a recession. But that is probably a story for next year, or I don't know, it could be the year after. So far, we haven't seen that pressure built up. We've seen the pressure rising, but it has not built up to a level that is so high that it tilts the overall economy. But the risk is that as time progresses, the pressure will get bigger and bigger. So to answer your question about US, it should still grow in the next 6 months, but the risk is gradually building up. In the case of China, sorry.
Yep. Okay. Go ahead. Sorry.
In the case of China, as shared earlier, the country can still grow its real GDP at about I don't know, 4%. It's still growing, but the problem is 4% real GDP growth in China's context is considered as quite weak. So to answer your question, they are still growing, they can still deliver growth, but the whole situation is very weak. If the Chinese government don't stimulate enough, I'm afraid real GDP growth can easily slow down to 3% or even 2% next year. So the ball is really in the government's hand. The government really has to do something to push the growth back. But if the government decides that they want to do what they, in their own term in the past, they call it quality growth and disciplined growth, there's nothing wrong with it. But discipline and quality growth, meaning without excessive stimulus and excessive borrowings, the price that you pay is you will face a sluggish growth, maybe 2%, 3% type of real GDP growth. If the government is okay with that, and if the people are okay with that, then it's a growth, but it's a weak growth. So that's the outlook for China. But I suspect there will be a lot of pressure from the day-to-day people for the government to do a little bit more to push the economic growth higher than 2 to 3%. But let's see. Yeah.
All right. Okay. Thank you, Chia Wei, for the sharing. From the interest rates perspective, perhaps Shawn or Hazlin can share. Do you think we are approaching the end of the rate hike cycle, whether it's the Fed or the developed markets or even other developing economies? Why so? Shawn, would you like to share on your perspective?
Yeah, sure. So, I mean, with the recent US inflation indicators such as the core CPI index showing an increase of showing I think around 4.65% year-on-year increase in the July's results, versus an increase of like 4.83% year-on-year back in June, and also falling off from approximately 5.6% at the start of this year. This has shown signs of gradual disinflation. However, it is still far off from the targeted range of 2% that the Fed is hoping to achieve. Additionally, I think I believe I've mentioned previously, a few members believe that the policy have achieved some sort of restrictive level that they are looking for. So I believe that we have some sort reached the end of the rate hike cycle, and we can roughly expect a pause in the September's meeting. And this is in line with the market consensus as well, which the Fed funds future curve have depicted in Bloomberg. So, I mean, despite saying all this, nothing is still guaranteed, as a sudden spike in inflation data could start the rate hike cycles to kickstart again. But I mean, I believe more indication may be given when Jerome Powell speaks this Friday at the Jackson Hole Symposium. Yeah.
Yep. Thank you so much, Shawn. Anything to add, Hazlin? Sorry. Thank you so much, Shawn. Anything to add, Hazlin?
Yeah, I agree with Shawn, because looking at the current increase in the US Treasury for 20 years and 10 years, we think that the rate hike is towards the end already. And then this weekend we can see that what the clearer direction from the Fed from the Jackson Hole Symposium. So as for the developed market, we think that the inflations in the European countries still high, so there's still room for them to increase further in 2024.
All right. Okay. Thank you, Hazlin, for the sharing. So, Hazlin, a follow-up question on that. From your perspective, how do bond markets, whether it's local bond markets or global bond markets, get influenced by international factors and geopolitical events?
Okay, for the international factors like war that we have recent Russian-Ukraine or Chinese-Taiwan or US trade wars, ban imposed on certain products, and geopolitical events definitely will give impact on the bond market. Those events definitely threaten the financial stability through financial channels. the imposition of financial restriction, increased uncertainty, cross-border credit, investment outflow could increase the bank's rollover and funding costs. After that, it will increase the interest rate on the government bonds, which is reducing the value of the bank asset and adding up the funding costs. I think most of us know that in March there is a bank run like Silicon Valley banks, which basically the effect of international events. We start from the Russia-Ukraine war, where the banks are loading up the long-term bonds, and then because of that, when the interest rate increase faster, they have huge loss on that, which is affect the depositors to worry about the deposits in the banks due to the fears of the bank solvency lah. So that's the impact of the international event. From my personal experience also, in the 1998 when the Asian financial crisis, we also having the same difficulties, where that time the interbank rate, the overnight rate shoot up until 50%. So that's a case of when the event happened in the national event, so affect the local market also.
All right, thank you, Hazlin. Shawn, would you like to add on top of what Hazlin has mentioned earlier?
Yeah, I believe my view is similar to Hazlin, because when economic growth is strong in the market, such as the period after COVID, where people are flush with cash, it prompts consumers to revenge spend when the lockdowns are lifted. That's where businesses starts to make more money, and when consumer continues to splurge, then this increases the demand for goods and services. So which can put upward pressure on inflation. Hence, to combat the inflation, central banks tends to raise interest rates, leading to higher bond yields, which is what we are currently experiencing right now. And to echo what Hazlin have mentioned earlier, the geopolitical events such as the war between Ukraine and Russia, it will also lead to uncertainty in the market, because businesses are disrupted, properties are destroyed, investors would tend to shy away from bonds that are issued from these countries, or even issuances that the companies has businesses in this region. And all these factors will be points of concerns for investors when they think of where to put their dry powder in. So this would then create like a shift of funds, or maybe a slowdown in transaction within the market, in the global bond market. Yeah.
All right, thank you, Shawn. Chia, do you see similar trends in the equity market?
Yes, a lot has been shared, so I'll keep it short. Yes, generally, global events, activities, they do have a big impact on equity market. Even whatever happen globally that affects bond market, the bond yield, it actually has an impact on equity market, because valuation of equity market is to a large degree contingent on bond yield. So if bond yield is very, very high, that means it's very attractive for people to buy bond. They can collect a high coupon. Then they will compare with investing in equity. If bond yield goes up, then they will demand a higher return from equity. That means to get a higher return from equity, that means you need equity share price to be lower to make it attractive for people to buy, to capture that higher return potential. Which is why you will see there are many periods in the past 2 to 3 years when bond yield rises, equity market will weaken during the same period. So that's one key relationship. Yeah.
All right, thank you. Maybe this question is directed to Shawn. Are there any recent trends, emerging patterns or innovations in the investment market that investors should have on their radar? And how do you think technology has influenced the trading and management of, say, fixed income securities?
Yeah, I believe in recent years, we are seeing much more technology firms and fintech trying to introduce bonds onto blockchains and fractional bonds, or even private bonds trading venues. issuers has also started offering hybrid tranches of digital bonds on the market. So unfortunately, we have not seen much traction to either bonds, but most bonds are still traded over the counters, and I mean direct private investors who have will not have such access to the liquidity pool which are open to institutional investors. So for fractional shares, I mean, the regulation still requires being a sophisticated investor or accredited investors declaration in both be it Malaysia or Singapore, respectively, before they can purchase the loose lots. So in overall, we will be looking forward to embrace technology onto bonds trading and investment. But for Singapore, we have allowed investors to have direct access to wholesale bond trading on our POEM's electronic platform. They can also do it directly with their account manager, who also has access to our platform, allowing more transparency over this platform. Yeah.
All right. Chia, would like to share, is there any emerging pattern or even new technology that has influenced the trading and management of equities?
To be honest, I'm not that familiar with all these emerging technologies that are used for trading and management of equity. So far, the popular methodology, the popular technologies that are widely used remain the same. There hasn't been much new ones. So that is in terms of trading and management of equities. But if you ask, like in terms of investment team, what are some of the emerging technologies that are in everyone's mind? I think most of you will be familiar. The AI team has been very, very hot. So AI stocks have done very well. We participated in them, but just to share that in the past 2 months, we have gradually taken profit because some of them have become too expensive. We've taken profit, and hopefully, if there's correction, then we may enter again. Yeah, I hope that answers your questions. I know there's a bit two different interpretations here.
Yep. All right. Thank you so much, Chia Wei. So maybe back to you, Hazlin. What factors should investors take into account when seeking to diversify their portfolios across bonds from various countries?
Okay, for assessing the fixed income portfolio, apart from normally we only look at the yield, high risk, high yield, but the following is a high risk, high return, something like that. So the other basic factors that related to the fixed income investment, like price, interest rate, maturity, redemption features like call provision, put provision, something like that. Investor also should check whether the bond is secured, unsecured, guaranteed, not guaranteed. What about the secondary market liquidity? Check out the coupon. Is it competitive with the interest rate at the moment? And then the credit rating of the bonds, the country itself, the credit rating of the country itself, the country political stability, economic outlook for the country, and also for the sector, and also for the conversion rate if you want to convert back to the ringgit, no? And I think the last thing is whether tax gain is tax on gain from selling of the bonds. So there is a lot of things that the investors should consider before they invest in, even though in our country. I mean, like outside the country also, even for the details lah.
Yep, seems that diversification is the key when it comes to investing. Is there anything to add for fixed income, Shawn?
Yeah, I believe Hazlin has shared quite extensively on the risks that investors should look out on. So I mean it's good to have a diversity of different type of bonds within the individual portfolios. And I mean, like Hazlin have mentioned, some of the factors that investors should look out for perhaps would be the credit risk of the bonds, as well as the details, the descriptions of the bonds. Is it investment grade or is it high yielding? But that said, I believe one should also keep a close watch on the capital management of the issuer that they are intending to lend the money to. which I think Hazlin have mentioned earlier, such as maybe if they have a good credit standing and what so. So secondly, I believe Hazlin has also shared that it will be good to look out for the currency risk, although it is good to not to put all your principal in a single currency. So I mean, investors should also take note on the exchange rate risk when investing in foreign bonds, because investors could either, if on a positive note, they could earn a higher, or if let's say on the other end of the spectrum would be a lower coupon when they are converting back to their lower currency. Then lastly would be for me, I would say our add-on would be the liquidity of the bond itself that they are investing in, because for those bonds which does not have much liquidity, it would be difficult for investors to let go without incurring a loss. So I mean, these are some of the factors that the investors should take note on before they invest in bonds. Yeah.
Yeah. Thank you so much, Shawn and Hazlin, for your sharing. We have covered quite a lot for global fixed income and equities. Zooming into Malaysia, Hazlin, Malaysia's 6 state elections held 2 weeks ago concluded with status quo. PHBN coalition retained the 3 states, Penang, Selangor and Negeri Sembilan, but with slimmer majority overall. Perikatan Nasional retained Terengganu, Kelantan and Kedah with super majority and with a clean sweep in all of Terengganu 32 state seats. He also made inroads into Penang and denied the unity government's 2/3 majority in Selangor. So what will be the outlook for Malaysian market moving forward, Hazlin?
Okay. The recent, I think the green wave, they call it, serve as a reminder for the existing elected ministers in the current government to work hard in the future actually. Since the parliament seats there is no change, so the current government have ample time to proceed with the economic plans that which they have already launched, like Madani Economic Plan, National Energy Transition Roadmap, and also reviving the KL Singapore HSR projects. I think the flow from this news already we can see in the stock market, which already affected the like some of the property companies start the price of the start increase after the news actually, because since there is no change in the government, so the mandate will be there. As of I think this all big ticket item definitely will be funded by the public and private funding, which we expect more issuances for these projects going forward. So we believe that the GDP for 2024 around 4.5 can be achieved.
All right. Okay. Thank you so much, Hazlin. Anything to add on top of what Hazlin has shared, Mr. Chia Wei?
Yeah, maybe just for a broad stroke on Malaysian equity market is the now that state election has over, it has definitely removed a key overhang, and we know that from now until the next general election for the parliaments of for the states, that is a few years away from today. So from global investors' perspective, they will view Malaysia as, hey, in the next 3 years at least, there will be a lot of political stability. There won't be any election to change the government or change the state government. So that is good. Because the political uncertainty has been one of the major overhangs for Malaysian market. So now that's sort of removed, at least for the next 3 years. So that by itself is good. Like Hazlin shared, it has already attracted foreign flows. We are already seeing KLCI improve. Some of the large cap has done better. So the state election issue has been positive. And now, hopefully with the implementation of some of the new policies that will help to spur a bit of growth above the organic level. Yeah.
Yep. Thank you, Chia Wei, for your sharing. On top of what you have shared earlier, looking at the inflows in the looking at the inflows in the Malaysian markets lately by foreign investors, do you think the foreign buying into Malaysian equities will continue to persist?
I think it should. But the area where I'm not sure is the magnitude. So far the inflow has been positive, but the magnitude has been quite gradual. I won't say it's like a huge inflow. I think it should continue to improve, but whether it will improve in a big way or in a moderate way, honestly, I'm not sure. If you ask me to take a guess, I think it'll be a moderate inflow. Why do I say that is, while the removal of political uncertainty in Malaysia is a good thing, it's a very good thing. But I think when global investors, foreign investors look at Malaysia, they also like to compare Malaysia with other countries in Asia. For example, they'll compare us with Indonesia, with Thailand, Singapore, and they will also compare us with places like India, Taiwan, China. So they will compare and see which is better. Now, naturally, if you compare Malaysia with China Outlook, for example, Malaysia actually looks better. If you compare Malaysia with Singapore in terms of growth, real growth, yeah, slightly better. But if one just focus purely on growth, some of the foreign investors may say, hey, the more interesting story is actually in India and Indonesia. So in that sense, I would not expect huge inflow into Malaysia. Because while Malaysia is okay, but there are other countries in Asia that stand out better. So that's the nature of foreign investors. Because they have options, right? They can choose whether it's Singapore, Thailand, China, India. So they tend to cherry picks. So to stand out on a relative basis matters too, to determine the inflows. Yeah. So to summarize, I think the positive inflow should continue because we have seen years of negative outflow. But is it a huge inflow, rapid inflow within the 6 months, 1 year? I think it's a bit tough in that sense.
All right, thank you, Chia Wei. Speaking about inflows of Malaysia equities market, we see Malaysia bond market also year to date we see very strong inflows amounting to over 20 billion ringgit. Is there any reason for this, Hazlin?
Okay, I think the latest numbers in the recent month, July, which is about 11 billion inflows from foreigners in the bond market, which is double from the previous month we having since year to date. So it shows that the interest from the foreign investors is there. I think the main factor that they will look at is the political stability. Since the new elected government led by the unity government, they call it the unity government, led the Prime Minister Anwar Ibrahim, giving some sort of like comfort to the investors with less change to the existing government policy. So that's why after the PM was elected, the inflow will start coming into the Malaysia. Compared to the last year, we saw outflows in the August months before the elections. So first, definitely political stability for Malaysia, and second, I think because the slow growth in the global economy, start from the beginning of the year, we noticed that most of the strategists start giving recommendation of high position in the fixed income, looking at the numbers from the World Bank and IMF about the GDP forecast for 2023 and 2024. So that's why the higher allocation for fixed income was put beginning of the year actually. So and third, I think the main reasons why Malaysia being having an inflows of foreign inflow in the debt markets is I think because the MGS and DII have been put in the major indices just like FTSE World Government Index. Bloomberg Global Aggregate Index, JP Morgan's JP Morgan Government Bond Index, Emerging Markets and Markets iBox Asian Local Bond Index. So our MGS TII have been put in the major indices. That's why easy for the foreign to trade. That's it. I think that's the reasons.
Yep. Thank you, Hazlin, for sharing. Seems that Malaysia remains an attractive destination for investors to consider. Perhaps the last questions for today's session. Hazlin, could an interest rate hike by the Bank Negara Malaysia potentially address the concerns regarding the recent weakness in the ringgit? Sorry, Hazlin, could an interest
Okay,
rate
sorry.
could an interest rate hike by the Bank Negara Malaysia potentially address the concerns regarding the recent weakness in the ringgit?
Okay. Bank Negara already mentioned that they will not use interest rate hike to tackle the weakness in ringgit. So I think recently Bank Negara governors are using forex to intervene to stabilize the ringgit. Other than that, I think the government also encouraged the exporters to convert the ringgit received, the dollar receive proceeds from their exports. And then other factors that I think that affect the direction of the ringgit is our structure of our economy. Our structure of our economy has changed from export oriented to domestic consumer oriented. This means that imports on the ringgit is rising and export is dropping over time. So I think the net fund flows from MNC repatriating profits back to the home countries and Malaysia companies from overseas also. That I think that's it.
Yep. All right. Thank you so much for the sharing, Hazlin. Right. Thank you so much, everyone, for dialing into the sessions today. Thank you so much to Hazlin, to Chia and Shawn for your insightful sharing. We'll see you in the next Phillip Roundtable session. Thank you so much. Thank you.
Thank you.
Thank you.